an honor to be on the final panel. Last year we did the same, and I think it really attests to, I would say on behalf of everyone, saving the best for last.
Yeah.
And also the people that are stopping you from going out for lunches and your next meetings as well. But I truly, truly believe that it will be a very, very insightful conversation. Reason being, amongst the four of us, a few of us actually flew over especially to join this conference. And reason being, with that, you get a more regional, beyond ASEAN view on things. And trust me, I would go into the questions that you want to know about, how to get allocations. But we're going to save that towards the end. Right, I'm thrilled to be joined by these three gentlemen beside me, and we'll kickstart this whole conversation with a statistic. 45% of family offices allocate into alternatives. So Justin, starting with you, do you agree with this statistic? And what does alternatives, broadly speaking, mean to you and your family?
Sure, definitely. So I'll maybe start by introducing a little bit myself. So I'm Justin, I'm the principal of �HEG. We're a Hong Kong-based single family office. So I came from a sell-side background. So I used to work at Goldman Sachs, Morgan Stanley, UBS, and I was employee number 3 at Uber in Hong Kong. So I started 𝐬𝐥𝐬𝐿 in 2018, and we're quite unique as a family office because our allocation to alternatives is pretty high. So we have a 50% allocation to alts. That includes hedge funds, private credit, private equity, real estate, and our biggest alts allocation is into hedge funds. And with hedge funds, we have a core satellite approach. So in the core side, we allocate to the multi-strats, the millenniums, the 0.72s, and because that delivers a low volatility, steady return, I'm able to make riskier bets on the satellite side. So on the satellite side, we do seed, first time, and young hedge funds.
Wouter, how about you?
Yeah, maybe start with a little intro of myself as well. So my own background is in investment banking. I spent some time at an activist hedge fund, then dipped into private equity before trying my luck as a startup founder. And now and this was quite shocking this morning when I realized that I led the family office for 12 years now. So goes to show how old I'm getting. About the family office itself, so we're a Singapore-based family office with European roots. I guess I represent those European roots.
Couldn't tell.
Yeah, it's not apparent. So we call ourselves a single family office for multiple families. What does it mean? It means that we have a slightly larger infrastructure that beyond the core family, we also leverage for other families. And we also have other families co-invest in the investments we do for the core family. And then specifically to your question, so what are alts for you and your allocation? Similar to Justin, our alts allocation is pretty significant. So I would put it at 50 to 55% on our end. But the difference between the two family offices here is that our strength, I would say, within alts is in private markets. And within private markets, the biggest chunk is private equity, where we run our own annual vintage strategy. But other than that, private markets for us also would, and thus alts also include private debt, venture debt, infrastructure, real estate. Our hedge fund side is present, but somewhat smaller, so around 5 to 10% target. So that's what alts entail for us.
Thank you, Wouter. Weeps, over to you.
Hello, my name is Weeping, or my friend Baldwin calls me Weeps for short. It's like weeping for crying. It's a different perspective for me. I am a second generation in the family business. I've never written a resume before, right? So that tells you a lot about me. I currently represent the family business. It's in real estate and construction as the chief investment officer, and I look after the investment side, obviously. So I think we are a little bit younger in terms of the investment journey. We started really shifting 100% from the operating business, real estate, and starting to go into what we call alternative investments. I think there's a lot of textbook definition on alternatives, but I think for me, just thinking of what we have done over the past few years, alternatives just means anything that that I don't really understand very well. There's little information, opaque, and that's alternative investments to me, which can mean anything, right? Even I've never touched equities in my entire life, so that's alternative personally to me. So like I heard what Justin said, alternatives is real estate. To me, that's like not alternative. That's very mainstream for me because we've been doing real estate for the past 50 years. But just within the real estate asset class, there can be the mainstream ones. You're buying an office building, and there can be very alternative types. In 2014, we went into student housing in Australia. We went big, put in a lot of money. The families supported me, and I think we have done pretty well. So I think that's considered something alternative too. In terms of allocation outside of kind of what we think is core, 100%, now we are about 10% into alternatives, private equity, venture capital, private credit, and some random investments. I can share more. But we are slowly inching it to 10% and probably over the next few years, 20%. It takes time to get liquidity from the illiquid stuff from real estate and turn it into cash and then look for new managers to deploy to. The last thing that I will share is, we are generally into funds. I don't trust myself to build a lot of capabilities around the alternatives. So we are constantly looking for, GPs to build a relationship and then deploy and build along with. My hope is after 20 years, I just deploy into the people that I know. I don't need to, do networking and all this stuff. Thank you.
So thanks, Weeps. I'll call you Weeping from now. We can see actually across this, there is a diversity of where each family's journey is in terms of investing and allocations. Maybe I'll go back to you since we are the youngest in terms of this journey. Looking ahead, right, you mentioned that you are still starting out in terms of this allocation into fund managers. Where are you going to look to allocate more moving into 2024?
I think the theme is going to be a lot on private credit, which I think these two peers will have a lot to share. But as I said, we are still young, and I think we are a bit late to the private credit game, right? Because I think a lot of people will tell GPs that, you need to be fundraising when you actually don't need the money, right? So about building the relationship. And I think that actually is very true for LPs as well, right? You can't expect to, when you want to invest in private credit and suddenly there's a bunch of 5 private credit funds available. The good ones, they will never reach your table because they have their own network of LPs already. So I think now, other than allocating to private credit and stuff, but we are setting up, very intentional programs and activities to go out, and not just Singapore, but to the world, right? So I think it's time for us to go out of Singapore, to US, to Europe, or other parts of the world to actively source for good opportunities, meet good people, good GPs, and then eventually you may only allocate in 3 or 4 or 5 years' time.
Thank you, Weeping. Wouter?
Yeah, so might be a bit of a boring answer, so sorry crowd, but for us 2024 is a year like any other. So our investment target is a 35-year target, so the movements or volatility in a specific year don't typically move our decision making. To focus a bit on the alternatives, because that's what we're mainly talking about, within the private equity side, we will simply make the same allocations that we make every year. The whole point of building a successful private equity portfolio is to invest across all different cycles of the market. So even when there's a market where now quite a lot of people have become hesitant to allocate into private markets, our philosophy is that we will simply allocate the same amount of money as we did in the hype year of 2021, as we did in a tough year 2022. So that will be the same in 2024. And then how do we allocate? So we have a fixed amount per year that we look at, and we always try and build a portfolio of 10 to 12 managers that we allocate to. Main strategies, buyouts, and secondaries. So that will be similar for 2024 as well. And around 40% North America, 30% Europe, 30% Asia. So for us, it's a bit more of the same. Public equities, we will simply sit and hold. On the hedge fund side, similar thing, typically sit and hold. I think On the private debt side, we'll be active, but not necessarily more active than the year before or the year after.
Got it. Thank you. Justin, how about you? What are some of the bets you're going to make?
Yeah, I mean, I echo these gentlemen to my left. Private credit, I think, really makes sense. The floating rate nature of it makes sense. I believe rates will stay high for quite some time. But we're really focused on managers that only do first lien senior secured direct lending. And for that, I'm looking for high single digit, low teens returns. So private credit, that's one theme. Another theme that we're looking at right now is we're still looking at secondary blocks, so discounted blocks of kind of startup companies. I literally just closed on a ByteDance block last week. And ByteDance to me makes sense because, I mean, the valuation is really reasonable right now. It's trading at below 3 times price of sales. I was finally able to find a structure that was 0 fee, cap table structure, 0 layers, and was bite size. So it made sense for a single family office like us to get into that trade.
Thank you. Oh yeah, this is the part where we get into the gist of the conversations of why we're all here at iConnections. And in terms of evaluating managers and funds, right? The typical textbook answer is performance, people, process, portfolio, platform. But we also identified that, I think, at various experience in terms of allocations, we also agree that sometimes the team that gets you from 0 to 50 might not be actually the same team that can get you from 50 to 200 in terms of scalability. Wouter, I want to start with you. How are you looking at allocations? You said more of the same, but within the same, how are you constantly evaluating them?
Yeah, so we have, I mean, it's strange to say that about your own process, I guess, but I would call it quite a rigorous process. So it's a multi-stage process. We have for the AUM that we manage rather significant investment team as well. We're 8 investment professionals across various seniorities. At the more senior side, we have 2 former GIC folks and then myself. We recently hired a director from 𝐬𝐿𝐼, so quite a lot of heritage, I guess, of folks that are used to an institutional setting, which probably influences how we look at allocating. I must say that out of the 5 Ps that you mentioned, performance for us, that's almost a hygiene factor. So performance needs to be there, and otherwise it's very difficult to get our attention or maintain our attention. So that also means that for some of our existing relationships, where we might almost be in love with the story of the manager or the strategy, that at times we need to take hard decisions and say goodbye to folks that we really like from that story point of view, which can also be the case where we meet a new team where we really like the story, but we cannot make the numbers add up. So performance is rather important. What we see, so coming to your point about can this team also do the bigger fund, or that's how I would simplify what you said. That's a very touchy subject for us. So we are strong believers in mid-market and lower end of the market funds. We wouldn't allocate to the big name funds, the mega cap funds, because that's not where the performance is. The performance is with the medium and smaller managers. The issue is that smaller and medium managers eventually grow from small to medium and then from medium to large. And then I think one of our most difficult tasks as a team, because everybody can do performance benchmarking and everybody can do a nice write-up about team or strategy or whatever, but the art is almost in deciding, is this the moment to leave the game of musical chairs and get out, or do we continue playing? So if you have a terribly successful fund manager that you've allocated to 4 times in a row, that has grown fund size, grown fund size, grown fund size, you started investing with them at a 400 or 500 million level, and now they're raising 2 billion. They might have some sidecar, other smaller fund. They have some other distractions going on. Is this the moment we get out, or do we play one more round with them? So I think we completely ascribe to the point you were making, or the question you were posing, that the answer is very clearly that not every team is fit for bigger and bigger. And what we also simply see is, as funds get bigger, so this is mostly private markets, right? That the management fee gets more and more important, and fund managers turn into management fee farmers. We, as a more nimble LP, are not beholden to enormous tickets that we need to fit into large or mega cap funds. So for us, it's a lot more attractive to go with the more nimble managers as well, that are still eager to get performance. So if we need fund managers to still get rich on performance, that's great, because we need performance. So we're not in there to try and find managers that will give us flat performance, or even on the buyout side. I mean, a 2x fund, like, okay, but I'm out there to try and find something that will do better than a 2xer, because I can find a bunch of 2xers. That's not an issue. Yesterday I spoke to an old friend of mine, and she said she was defending some of her selections into the mega cap names, and she's like, well, at least they won't lose money. Like, well, that's not a very tough hurdle to meet in private markets, especially on the buyout or secondary side. If you are a secondary manager consistently losing money, you're an anomaly. You've discovered something great, because no secondary manager in the world is able to consistently lose money. So that's not what we aim for. We aim for stellar performance, so top quartile type funds, and yeah, we dig in as a team to try and find them. And so given that we were slightly larger and more advanced with 8 investment professionals, so we do go out and try and reach these global firms, so also firms in North America and Europe, and we do it from Singapore, which at times leads to, yeah, calls at awkward times, but yeah, that's the price we have to pay, I guess.
Thank you. That's really good. Now I'm going to throw it to Weeping.
Yeah.
Reason being, I think it's going to be a very contrasting angle where you come from in terms of evaluating managers. I think during our prep call, you mentioned that I might invest in them because I don't know how to do what they are doing, right? Can you give us a bit more color on that?
I think maybe putting that back, it's a reflection of what I hope to do at the family office. Because, you know, the first generation created, you know, a little bit of wealth. And I think as family office, our job is, you know, just don't lose it, you know, and grow meaningfully. Like, I'm not expecting a 10 times return anytime soon, right? So, but at the same time, I always struggle to know, how do I pass on or inherit that entrepreneur spirit, you know, that my dad and my uncles built up in the business, and then pass it on to kind of my fellow second generation and to future generations. You know, and while we can get, you know, capital asset allocation sorted, you know, over the past few years, what we have been doing actively is to just seek out people with, you know, sort of a good strategy, and then we seed some capital, and then we see how it goes from there. You know, like, you get into you really roll up your sleeves. You know, and my philosophy is, if you don't invest, you never learn anything, you know, which might be very different from a much more established setup. But of course, you don't pour millions and millions. You just, you know, put a few $100,000 or stuff. So I think and that's how we got into random investments. For example, I just said I wanted to know what this whole sustainability investment is all about. So, you know, we spoke to a bunch of people and then seeded a strategy. They're doing pretty well, you know, and I learned a lot by interacting with people in that space. And then I move on to, call it like a GP selection stuff. So I might speak from the perspective of venture capital funds, because we do that quite a bit. Past 5 years, we've done more than 10 VC funds in this region, and now we are putting our focus into North America. So I've been to the States quite a bit this year as well. At the end of the day, it's all about pattern recognition. You put a bunch, so we've seen more than 100 funds, right, you know, just this year alone. And you start to get a sense of what you like and what you don't. It might not necessarily be the right choice. You never know, because it's all about the person that you're investing in. And then we have our own metrics in terms of what we are looking out for. But one strategy that we have developed is to kind of just put relationship checks. That means that you might be a bit too early, but we'll put 100K with you, and then so that we can continue to build the relationship with you. And a very important thing that we always track after that is when you're doing your fund too and you're going out to raise your fund. I think strategy compliance is quite important to us in terms of have you actually done what you said you will do in your fund one, right? You said your portfolio construction is 250,000. You don't lead any rounds and blah blah blah. Everyone has different portfolio construction, but we want to see how far you have deviated, and you'll be surprised. Some people really do deviate quite a lot, especially I think in the private market. I think that strategy compliance, just the personality of the GP and the team is quite important, because it's potentially a 15-year relationship. Funds are structured as 10 plus 1 plus 1, PE, VC, right? But if you look at the data, it shows you that people exit only year 15, fully exit the fund. So, yeah, it's a very long relationship. It's almost like getting into, a marriage or sorts, right? So it's very important for us to invest in the right person and the team, and just, our exception for strategy and stuff. So the person is very important. Yeah.
Thank you, Weeping. The term multi-strategy, big names came up a lot during our conversation and throughout the entire 2-day conference as well. Fees are being passed on to investors right now. The fees are getting higher and higher to retain talent. Justin, I know you are quite invested into these platforms or multi-strategies.
Yep.
What is your thought?
I think for us, fees and liquidity is not a big issue. I don't mind paying fees if you can deliver performance. And I don't mind holding on if you can gate me all you want. I'm happy to be gated because we're long-term investors. So I'm a little bit different from you guys because I don't allocate to private equity or VC funds. I like to do direct deals myself. So when I do manager selection, it's really just for the hedge fund side. So as you mentioned, on the core side, the multi-strat side, performance is key. So we look at needs to be low volatility and high Sharpe, and that's pretty much it. Yes, the liquidity, I'm happy to be gated. I'm happy to sit for 10 plus years on that side. On the satellite portfolio, when we see these new hedge funds, a lot of it, I'm betting on the person, right? You can backtest all you want, but you're really betting on that manager. So what I do is I do a lot of channel checks. This industry is very, very small. Reputation is key. If there's any red flags, I will find out just after a few phone calls. And also with these managers, the young managers, it's kind of like their performance kind of comes when they are not performing. So their characteristics come out. So for example, we seeded a crypto hedge fund in February of this year. Right now we're net down 5%, which is not that bad in the grand scheme of things, but because my motto is also don't lose money, anything that's less than zero is unacceptable. But then that manager really over-communicated every month with performance and their strategies. And when I do see these funds, I do tell them, you have 12 months to perform, and I'm going to redeem if you don't perform. So they know that from day one. This particular manager, because they were underperforming, they over-communicated, and then they had almost like a roadmap onto how they're going to pivot their strategies to hopefully turn for the better. And because of that, I was impressed, and that bought them more time. So they have another 12 months to prove themselves.
That's very insightful and very good advice as to how do we keep these communication channels open. But I think today, in the past 2 days, we had a lot of first initial conversations for a lot of us in the room. I guess on behalf of all the managers in the room and outside, what would be something that they can do or something they can say to catch your attention? I'll throw this one to Weeping first.
Me first. I think it's impossible to do any kind of sensible, convincing pitch in the first conversation, right? So I think I think the overall arching goal is really just to build the relationship. We have to almost seek your forgiveness that, we see so many deals and so many GPs. There are a lot of unanswered texts on my WhatsApp and LinkedIn inboxes, it's very unintentional, right? Because there is only so many of us. But I find that I will respond to those that nudge me a little bit more often, right? It's almost to the point where I feel a bit embarrassed, that I haven't returned your text and stuff, and I decided to, let's do a half an hour call, So I think that's one way to do it. And I think just be present in a lot of all these events, because these are events that we go to as well, right? I see you once, and I see you again. Oh, okay, this guy looks familiar, and I see you 3 times. That's literally how we put a check into one of the, it's a small fund in the US, 10 million. Like I saw him everywhere in all the events, and we just had a lot more opportunities to talk, right? And then once we talk, we engage, and then that's how a deal got done. He was even with us in Seattle when we were watching the Dota competition, right? So like he's literally everywhere. Yeah. Anyway, side story.
That might sound not a bit stalkerish, but I think it's called consistency. That's the
Consistency, yeah.
very easy for. Wouter, how about you?
So I would also agree with the point that we're getting quite a lot of inbound, and I personally am quite harsh there. So if I just get cold outreach, it's automatic trash can, or even if you're unlucky and I have a bad day, it might be a junk flag as well. So that's, I would say, not the way. A great way to get our attention is performance. So even while we allocate to around 20 managers on the private market side per year, we have quite a good sense of where the holes are for next year, so specifically which type of funds we're looking for. If we don't have existing relationships that can fill these holes, then we will mine Preqin or Cambridge Analytics, or we will ask befriended family offices or some of our institutional relationships for recommendations. So I would say if you want to get on our radar and it's not through performance, then typically a reference or referral would be the way to go. Not a cold outreach, not a pitch at an event, either in my case. So I plan after this chat to hide in the speaker room, have my lunch and run out. That's what I typically do at events. And actually, while Weeping was talking, I came up with one way that actually at times does work. So interestingly, GPs seem to want to email me or one of the other partners. They should realize, so I run a family company, I run a family office. I have 11 years or 12 years of existing relations within all private markets. I need to portfolio manage a public equities portfolio and a private markets portfolio, do business development as well. So yeah, I might not be the right person to send a cold thing to. On the other hand, we have 3 eager beaver analysts that do nothing or would prefer nothing more than sit in investment meetings. So actually get the attention of one of the analysts, have them listen to the story, have them get excited, have them bring it to the pipeline meeting so that it comes to me. Hey, all of a sudden we're talking, right? So maybe, and it's new, it just came up now, right? So I wasn't prepared, didn't think about this, but that actually might be a tip. So don't reach out to the partner or managing partner or CEO, whatever title, fancy title people go by, but go with the analyst, the associate, the investment manager, the folks that still need to build their own relationships, that are still eager for every new bit and every new exposure that they can get. So that might be valuable advice. I don't know. Might be useless as well.
No, that is very right on the nail, right? Like these investment teams, your analysts are the ones that are actually doing due diligence, filtering, right? In a sense, to actually echo it up into the pipeline. But what it also triggered me was a thought earlier, just now while we were preparing, Wouter and Justin were showing us pictures of where the organization chart was, and from a technology standpoint, I felt like this looked like a system mapping rather than a mapping of individuals. If you ever get a chance to talk to both of them, maybe not Wouter, he's eating lunch, ask them to show you that picture. It is amazingly scary in terms of the scale and depth as well. Justin, I didn't forget you. What is something that people can do to catch your attention?
So we're a very lean team. I'm essentially a team of one, so all the inbound comes to me. I would say email is still the best form of communication. I use an email agent called Superhuman, and that helps me triage all my emails. What I do not like is when I get WhatsApps, LinkedIn DMs, or even instant Bloombergs. I'm on Bloomberg all day long. Like that feels like almost like in my face. So email is still the best way.
And talking about emails, in terms of, you're going to receive a lot of emails from a lot of people later. I know performance is one thing. What are some other details that you feel like would be interesting for you to catch your attention? I'm trying to help them write the email around.
Yeah.
Well, so I think my second one post-performance would be consistency of the team. So how long has the team worked together? What are some achievements that the team have shared? Or maybe even, I mean, maybe they've gone through tough times as well and stuck together, right? That's also possible. But most often, I mean, we're trying to find managers. Managers are teams of people that hopefully lead to great performance. So this team aspect's pretty important to us. And I mean, sure, if you're a micro VC, then it can be a single GP. That's all fine. So rather limited team, but then we want to see your track record from before, I guess. But otherwise, yeah, what brought the team together and how have they interacted? Maybe another point to make, because I know as a Dutchman I will have come across rather harsh, and but it is true that it's automatic trash bin. We are more open for other types of outreach. So if other families reach out to see whether we can help them in family office setup, or even talking about wealth transfer, how to run a strategic asset allocation, to co-invest. I mean, these type of things we're a lot more open to, almost call type outreach, or helping people set up VCCs. I mean, lots of things there could be of our interest. But yeah, so on the GP side, what should the email contain? Performance. I mean, I still get emails going, we have this and that strategy and blah, 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 and this is now fund 2 or 3, but they don't mention what the performance was of the earlier funds, and or whether they were top quartile. And if you're not top quartile, I'm sorry, but then, yeah, doing the cold outreach is probably going to be very tough. You probably need to find a placement agent that buys the story and has deep ingrained relationships with some folks that will listen to the story.
Thank you. Anyone wants to add anything on that?
I would say like a simple Google search on our companies, so you know what our mandates are, what we kind of invest in. Like if you're going to pitch something that's completely out of my scope, then it's automatic trash, 100%.
Yeah, happens quite often, right? So that indeed you get something which is so left field that if they would have thought about our profile, they would have known that it's a no-go from the start. Yeah.
Thank you. So I guess in summary, it's really about consistency, building the initial relationship, initial network. It could be at events like this, just a quick hi, and then now you kind of have a feeling of how to write that email. I hope that was really useful. And finally, thank you all for joining us today. I will let Wouter get to his lunch right now. I'm also absolutely famished. Thank you everyone for joining us at iConnections 2023. I hope you enjoyed our conversations. Thank you.